It's okay, Christine. It's safe to look again. You can uncover your eyes.
I'm really excited about this next
Let
segment.
me tell you, if you weren't looking, you would have missed a remarkable run-up in the market since the low in this market in March to now. You would have made several times what you would typically make in a year invested in this market.
And in our case, it means you're clawing back some of those horrible losses from the last couple of years. You know, the market's up, but you know we're seeing what some are calling a fally, a faux rally, false rally, fallacy rally. Is that what it is, a fally, or are these gains here to stay?
Well, the bottom line is, what are you supposed to do with your money right now? Our good friend Doug Flynn is back with us from Flynn Zito Capital Management. Doug has been sort of advising us all for years on these matters. Here's an interesting thing. Doug, you're not really interested in speculating about where the market is going. Your advice is make a decision and engage the market and have a strategy about what you feel safe with.
Yes, one of the things that we've been hearing is that people have a clear idea of whether they think that the worst is behind us and we're moving forward, or they think this is nothing, we're in for more doom, or they're just really unsure and they think we're just going to move along sideways. And you can make money in all of those scenarios. So we're spending a little time focusing on, not for your core portfolio, but for the outliers, how to take advantage of each of those.
So you need to know what kind of investor you are, first of all. So let's look at that. You know, if you believe the market is headed to 11,000 to 12,000.
Right. The argument there is that we were at 11 or 12 before this implosion last September. If depression's off the table, maybe we'll just get right back to where we were. And if we're going back there, what you've got to do is get back in. A lot of people did bail in March at the low. They missed this recent run-up. And so what do? If you need to get back to your original long-term allocation. Remember, we've spoken about that many times. If you have a diversified portfolio, you want to get back to it. If you're off of that, if you've sold out, it's time to get back in.
You also have stuck in a sideways range and also going to hell. You know, some days I'm all of these things at a different time of the day, depending on what's happening.
But I would say most people are in that middle category, right? We're not entirely certain the market's going to surge ahead. Right. We're not entirely certain it's not going to go the other way.
Well, you either have that clearly defined, you think it's going sideways, or you just don't know. And if you just don't know, then you're probably in the middle.
Right.
And so what you want to do there is you want to go back to the allocations that you originally had, but in the alternative space, take advantage of some of those neutral strategies, bring in some more fixed income, things that can participate in a sideways market. We've been saying for a long time that we think we're in this range of 7,500 to 9,500 on the Dow. We're not clearly breaking out above or below that. And if you just bounce around sideways, you know, portfolios are doing great if they're diversified. They didn't do well at the end of last year, but now they're doing really well relative to the market by taking advantage of that.
If you're in that second category, I mean, I just saw that screen there. It said you should be dollar cost averaging. If you think things are going sideways, you should still be putting money in.
Dollar cost averaging. It means every paycheck you're putting $100, $200, whatever it is.
Or
$2, $5.
It could be whatever.
It's been a rough
it could be
couple of years.
But also if you're out in cash and you don't know today, do I put it back in? You can set it up to move that chunk of cash in portions. In portions.
Over how much time? It depends on how much money you have?
I would say 12 to 18 months is always the ideal time frame, but you could shorten it up if you want to.
If you think things are moving faster.
But share accumulations, building up shares by getting it in, and higher dividends, that combination. Those things are the things you want to focus in on if you're unsure, if you think we're going sideways. This is how you do it. You can move it in with a chunk of cash. You don't have to pick today to do it. You can simply set it up with your fund company or your 401k provider.
Yeah, and everybody does this. They'll allow you to set it up.
I have a friend whose oldest daughter's going into college, and he's got another daughter who's 2 years old, and he said, boy, he just got killed on the money he'd saved in the markets for the older daughter. But the younger one, he's hoping he was piling money in that one, so he was trying. But that's what the whole point is.
And I think that's important because you deal with a lot of people when it comes to financial planning. People are planning for their immediate future. They're planning for the kids and for their education, and you don't want to get derailed by what happened in the last year and be scared of the markets.
And if you're thinking about last year or what's going to happen in the next week or the rest of this year, you're talking about being a speculator. You're not talking about being an investor. And you have to get back to being an investor. An investor is long term. It's when are your goals? If your money is not you need it for 10 or 20 years, these are the strategies that you want to implement.
Let's quickly touch on your last one. This one's a little more dangerous. If you're one of these people who think the market is going down, and there are a proportion of people who think this is false, you can bet against the market. You mentioned market neutral strategies. There are funds that are market neutral, and there are some funds, and you've got some of them here, that are inverse. They bet the opposite direction.
True.
So if the Dow goes down, you can make money on these.
Now, I would say you'd probably want to use this for in the alternative space in lieu of the other ones and keep your core portfolio.
So this shouldn't be your whole portfolio. This is just an extra spot to give yourself some hedging.
That's how you do it. You keep the core in place. You play with the explore part of it. But if you're firmly convinced, and I've got to tell you, in all the years I'm doing this, 20 years, I've never had more people tell me they really think that we're going back down.
Really?
Yeah, it's kind of interesting. And so what we do now is we talk about that. How do you put your money behind what your belief is and make money in it? You could be wrong, which is why you don't want to do all of it. But if you're right, how do you take advantage of it? One of the ways is if you're firmly convinced, short the market. You don't have to do it yourself. You can do it with a mutual fund or an ETF. And if you're really convinced, why just short it once? Short it twice, and that's what some of those funds do.
This is a 2 times sector select or 2 times S&P 500.
Which means if the S&P
goes down 5%, your fund gains 10%.
Exactly, and vice versa.
Yeah.
So that's
not a long-term strategy.
These are trading strategies. They're short-term, and I would put to you that all of these we're going to hell in a handbasket kind of scenarios, unless you really think we're going there for good, are really trading strategies. Have an end game. It's not a buy and hold
and
forget.
about it,
Exactly. You have to.
You know what I love about Doug Flynn from Flynn Zito Capital Management is he got his start in this business during the 1989 debacle, so he knows what it's like to be through all the. I mean, he's got a lot of experience.
And he talks to real people who come with their real problems and tell them how do we fix it. Doug, great to see you as always. Thanks,
you. Thanks, Doug. All right, there's some real signs the housing market is at least stabilizing here. We'll tell you what it means for the value of your biggest asset, your house.
And why a photocopy could save the U.S. government $500,000 a year. It's all in the ticker next.